I'm about to do something that almost no one in the silver community is willing to do. I'm going to make the bear case. Not because I'm bearish. I'm on record with targets of $92, $100 and beyond, based on fundamentals I fully stand behind. But I owe you honesty. The honest truth is that silver could visit $70 before it ever sees $100. And if you're not prepared for that possibility, you'll make the worst decision at the worst possible time. I'm going to walk you through exactly how $70 happens, what triggers it, what it looks like on the way down, and most importantly, the specific strategy that protects your capital and positions you to profit regardless of which direction silver moves first. This is the video that could save your portfolio this month. Let me start with the bear case, because understanding your enemy is how you defeat it. The path to $70 requires 3 specific catalysts firing at the same time. Not 1, not 2, but all 3. If only 2 fire, silver holds $80. If 1 fires, silver chops sideways. But if all 3 trigger within a compressed time frame, the combination creates a liquidation cascade that feeds on itself and drags price down 20 to 25% from current levels before the physical market can absorb the selling. Here are the 3 catalysts. Bear catalyst. 1. The margin hike sequel. The CME raised silver margins by 36% last month, and that was devastating. But here's what nobody's talking about. The CME can raise margins again, and there is no limit to how many times they can hike maintenance requirements. If silver rallies from current levels and open interest begins rebuilding above 85,000 contracts, the CME has historically responded with another margin increase to prevent what they call disorderly market conditions. A second margin hike of 20-25% on top of the current reduced rate would push effective margin back to 17%, triggering another wave of forced liquidation among traders who rebuilt positions after the first hike. The first hike dropped price from $91 to $83 in just 3 hours. A second hike from $85 could drop price to $73 in a similar time frame. The CME has done back-to-back margin hikes before. They did it in April and May 2011 during the last major silver squeeze, and silver fell from $49 to $33 in just 4 days. The 33% collapse engineered by 2 consecutive margin increases is the historical template for a move to $70. Bear catalyst. 2. Managed money capitulation. The commitment of traders data shows managed money has been reducing long exposure for 3 weeks, going from 92,000 net long contracts in January down to 61,000 currently. But 61,000 is still a substantial long position. During the 2020 crash, managed money went to 23,000 net long before capitulation was complete. During the 2018 decline, they went to 14,000. A full capitulation from 61,000 to 20,000 would represent 41,000 contracts of selling at 5,000 ounces per contract. That's 205 million ounces of paper selling hitting the market. That volume dumped into a market where daily physical trading averages 300 million ounces would overwhelm the bid side for 2 to 3 consecutive sessions, creating the waterfall chart pattern that triggers retail panic selling on top of institutional liquidation. The trigger for this capitulation is a break below the 200-day exponential moving average, which currently sits at $76.23. Algorithmic trend-following systems, managing approximately $40 billion in commodity capital, use the 200-day EMA as their primary trend filter. Above it, they're long. Below it, they flip short. A daily close below 76.23 would flip $40 billion of systematic capital from long to short. And that selling combined with a potential margin hike creates the cascade to $70. Bear catalyst. 3. Dollar spike from war escalation. This is the counterintuitive one. The US-Iran conflict is currently supporting oil and creating inflation expectations that should be bullish for silver. But there's a scenario where the war becomes so severe that it triggers a global flight to pure liquidity. If Iran successfully strikes a major oil processing facility in Saudi Arabia or the UAE, the resulting supply shock could push oil above $150. At that level, the global economy enters immediate recession territory. Recession fear triggers a rush to cash, the dollar index spikes above 102, and dollar-denominated commodities crash across the board, including silver. This is exactly what happened in March 2020 when the pandemic triggered a liquidity crisis and silver dropped from $18 to $12 in just 10 trading days, a 40% collapse driven entirely by dollar strength. The dollar is already at 99.3, so a 3% move to 102 is well within range if the war escalates beyond current parameters. Now here's the critical calculation. What is the probability that all 3 catalysts fire simultaneously? Based on historical frequency analysis, the probability of a CME margin hike in any given month during elevated volatility is approximately 35%. The probability of managed money capitulation below the 200-day EMA is approximately 20% given current positioning, and the probability of a dollar spike above 102 is approximately 15% based on options market implied probability. The joint probability of all three occurring simultaneously is 35% x 20% x 15%, which equals roughly 1.05%, approximately 1 in 100. That means there's a 99% probability that silver does not reach $70 through a simultaneous triple catalyst event. But 1% risks are not 0% risks. In financial markets, 1% events happen far more frequently than the math suggests because catalysts are correlated, not independent. A war escalation that spikes the dollar could trigger margin hikes, which could trigger managed money capitulation. That correlation increases the joint probability from 1% to approximately 5 to 8% based on stress testing models. A 5-8% probability of a 20-25% decline is a realistic tail risk that you need to plan for. The survival strategy, how to win in both scenarios. Here is where this video becomes the most valuable content I've ever produced. I'm going to give you a framework that protects your capital if silver goes to $70 and maximizes your upside if silver goes to $100. The framework has 4 components. Component 1, position sizing by conviction tier. Divide your total intended silver allocation into 3 tiers. Tier 1 is your core position. This is physical metal held for the structural deficit thesis. The deficit is 67 to 117 million ounces annually. It is structural, it is permanent, and it does not disappear if silver drops to $70. Tier 1 should represent 40% of your total allocation, bought at current prices, and never sold regardless of price action. If silver goes to $70, your Tier 1 position is down 15% on paper. And it doesn't matter because you're holding it for the 3 to 5 year thesis that resolves at 200 plus based on cumulative deficit math. Tier 2 is your tactical position, representing 30% of your intended allocation, and you do not deploy it at current prices. You deploy it at defined buy zones. Mine are $79.50 or $80.50 for the first tranche, and $76.50 for the second. If silver goes to $70, you haven't deployed Tier 2 yet because your buy zones weren't hit, and you deploy at $70 with the 200-day EMA as your reference. If silver goes straight to $100, you deploy Tier 2 on the first pullback after the breakout, which historically occurs within 3 to 5 days of the initial move. Tier 3 is your asymmetric option position, representing 30% of your allocation, held in cash, specifically reserved for extreme scenarios. If silver hits $70, the 5-8% probability event, you deploy Tier 3 aggressively because $70 silver with a 117 million ounce structural deficit is the buying opportunity of a lifetime. If silver hits $100 without pulling back to your buy zones, you deploy Tier 3 and long-dated call options on silver miners, which offer leveraged upside with defined downside. Tier 3 is your dry powder for maximum opportunity. Component 2, the stop-loss architecture. Physical silver does not get a stop-loss. You do not sell physical metal based on paper price movements because the entire thesis is that paper price is disconnected from physical reality. Futures and ETF positions, however, require mechanical stop losses. My stop loss for any tactical position is a daily close below $73.90. That level represents the January swing low, the pre-breakout base, and the level where the 2025 bull market structure completely fails. A close below $73.90 means the thesis is wrong or the timeline is extended beyond my risk tolerance. I exit, accept the 2-3% portfolio loss, and reassess. The key distinction is between a stop loss and a liquidation panic. A stop loss is a predetermined exit at a predetermined level for a predetermined reason. A liquidation panic is selling everything at the worst possible price because you can't handle the drawdown. The survival framework eliminates liquidation panic by ensuring your position size at any given price is small enough that a further 20% decline doesn't threaten your financial stability. If your total silver allocation is 20% of your portfolio and Tier 1 is 40% of that, your core position is 8% of your total portfolio. A 20% decline in silver reduces your total portfolio by just 1.6%. That is survivable, that is not panic-inducing, and that allows rational decision-making during volatile markets. Component 3, the dollar hedge. If the bear case is driven by dollar strength, then the hedge is dollar exposure. Hold 10-15% of your liquid portfolio in short-duration U.S. Treasury bills or a dollar money market fund. If the dollar spikes to 102 and silver drops to $70, your dollar position gains 2 to 3%, while your silver position loses 15% on the Tier 1 allocation. The dollar hedge doesn't eliminate the loss, but it reduces the portfolio impact and provides cash to deploy into Tier 3 at lower silver prices. You are converting dollar strength from a threat into an opportunity. Component 4, the miner hedge. Silver mining stocks are currently trading at historically low valuations relative to the silver price. The average price to net asset value for primary silver miners is 0.78, meaning the market is pricing miners at a 22% discount to the value of their silver reserves. If silver drops to $70, miners will drop further due to their operating leverage to the silver price. But if you wait for the $70 level to deploy Tier 3 into miners at 40-50% discounts to NAV, you're buying assets that will triple when silver recovers to $100. Rick Rule recently sold 80% of his physical silver to rotate into junior miners specifically because he sees this valuation gap closing violently in the next phase of the cycle. The miner hedge isn't about timing the exact bottom. It's about owning the production source at a discount when the market misprices risk. The bullish case remains dominant. Now that I've given you the honest bear case and the survival framework, let me reaffirm why the bullish case is the 92-95% probability outcome. COMEX registered inventory stands at 81.4 million ounces, draining at 1.7 million per day. Shanghai premiums are at 1620, breaking all-time records daily. The oil-silver correlation is flipping positive after day 11. The structural deficit has been revised upward to 117.5 million ounces annually. Chinese export restrictions are permanent and tightening. Mexican production is collapsing under cartel violence. Refining capacity is being curtailed by energy costs and chemical shortages. Military consumption is destroying silver permanently with zero recycling. The Federal Reserve is trapped between inflation and recession, with both outcomes bullish for metals. Every fundamental data point supports higher prices. The bear case requires 3 low probability catalysts to fire simultaneously against the entire weight of physical market reality. But markets are not rational in the short term, and markets can stay irrational longer than you can stay solvent. That is why position sizing matters more than price prediction, and why having a plan for both scenarios matters more than being right about direction. If silver goes to $70, you survive, with your Tier 1 core position intact, your Tier 2 dry powder ready to deploy at maximum value, and your Tier 3 asymmetric capital positioned for the buying opportunity of the decade. If silver goes to $100, you participate fully, and with your Tier 1 capturing the move, your Tier 2 deployed at buy zones for additional exposure, and your Tier 3 available for miners or options that leverage the move higher. The only losing strategy is the one most retail investors follow, 100% allocation at a single price point with no stop loss, no position sizing framework, and no plan for adverse scenarios. That strategy turns a temporary drawdown into a permanent loss because it forces liquidation at the worst possible moment, when pain exceeds tolerance. I'm not predicting $70. I'm assigning it a 5 to 8% probability based on quantifiable risk factors and preparing accordingly. I'm not predicting $100 either. I'm assigning it a 45-50% probability based on fundamental convergence and positioning accordingly. The remaining probability covers sideways consolidation between $80 and $90, which is resolved by the same framework because Tier 1 captures any upside from the base and Tier 2 deploys on pullbacks within the range. 5 to 8% chance of $70, 45 to 50% chance of $100, 35-40% chance of sideways between $80 and $90, and a 100% chance that the structural deficit continues deepening regardless of where price goes this month. The deficit is the thesis. Price is the noise. Survive the noise, profit from the thesis. This is the honest video. No hype, no hopium, no doom. Just data, probability, and a framework that works in every scenario. Share this with someone who is overexposed with no plan, because this is the video that keeps them in the game long enough to win.